What if I told you there's a way to invest that beats most experts, takes almost no effort, and works whether you have $100 or $1 million? That's the power of index funds. For most beginners, the stock market feels intimidating. You may hear about traders glued to their screens, chasing hot stocks, or losing everything overnight. But here's the truth. You don't need to be a Wall Street genius to grow wealth. Index funds are the simple, beginner-friendly way to start investing and actually win in the long run. In this video, we're breaking down everything you need to know about index funds: what they are, why they work, the types available, how to get started, the mistakes to avoid, and even a simple portfolio setup you can copy today. What exactly is an index fund? At its core, an index fund is like a basket of investments. Instead of buying one company's stock, you buy a slice of an entire group of companies. For example, if you buy an S&P 500 index fund, you're investing in 500 of the biggest U.S. companies from Apple and Microsoft to Amazon and Alphabets. Think of it like buying a smoothie. Instead of buying individual fruits like apples, bananas, and berries separately, an index fund blends them all together in one simple product. That way, you don't have to worry about whether one piece of fruit goes bad, because the mix balances itself out. Why index funds beat most investors? Here's a surprising fact. Over 80% of professional money managers underperform the market over long periods of time. They are experts with research teams, advanced softwares, and years of experience, yet most of them can't consistently beat the simple market average. Why? Because trading individual stocks is risky, emotional, and often expensive with fees. On the other hand, index funds are low-cost, diversified, and automatic. That's why legends like Warren Buffett recommend index funds as the best investment for everyday people. What are the different types of index funds? Not all index funds are the same. Here are the main types you'll encounter. 1. Stock index funds. These track markets like the S&P 500 or the total stock market. They're designed for long-term growth. As an example, Vanguard Total Stock Market ETF or VTI. 2. Bond index funds. These are used for stability, especially as you get closer to retirement. Lower risk, steady returns. As an example, iShares Core U.S. Aggregate Bond ETF or AGG. 3. International index funds. Give you exposure to companies outside your home country, helping diversify your portfolio globally. As an example, Vanguard FTSE All-World ex-US ETF or VEU. 4. Sector index funds. Focused on specific industries like tech, healthcare, or energy. These can have higher returns but also higher risk. However, you'll see index funds available in two forms: mutual funds and exchange-traded funds, ETFs. For beginners, ETFs are often simpler. They trade like stocks, usually have lower costs, and you can buy them with just a few clicks. How to get started with index funds. Now let's break this down step by step. Step 1. Choose a brokerage. Pick a trusted platform like Vanguard, Fidelity, Schwab, or even newer apps like Robinhood or eToro. The key is low fees and ease of use. Step 2. Define your goal. Are you investing for retirement, long-term wealth, or passive income? Your goal shapes how aggressive or conservative your portfolio should be. Step 3. Pick your first fund. For most beginners, a total stock market index fund or S&P 500 fund is perfect. For example, investing in VOO, Vanguard S&P 500 ETF, instantly spreads your money across 500 companies. Step 4. Automate your investments. Set up automatic deposits weekly or monthly. This is called dollar cost averaging. You'll buy more shares when prices are low and fewer when they're high, but overall, you'll smooth out the cost and avoid the stress of timing the market. Step 5. Stay consistent. This is the golden rule. Ignore the headlines about market crashes or bubbles. Just keep contributing. That's how you win. What are the common mistakes to avoid? Even with index funds, beginners can stumble. Here are the big traps. Trap number 1, trying to time the market. Waiting for the perfect moment usually means you miss out on growth. Trap number 2, panic selling. When markets drop, many investors sell at the worst possible time. Index funds are designed to recover if you stay patient. Trap number 3, chasing hot sectors. Putting all your money into trendy sectors, like tech or crypto, can backfire. Trap number 4, ignoring fees. Even a 1% difference in fees can cost you thousands over decades. Stick to low-cost funds. Trap number 5, not diversifying. Don't put all your eggs in one basket. That's the beauty of index funds. They diversify for you. Here is a simple portfolio setup you can copy. If you want a straightforward portfolio, here's a setup that works for most beginners. Selection number 1, U.S. Total Stock Market Index Fund for long-term growth. Selection number 2, International Index Fund for global diversification. Selection number 3, Bond Index Fund for stability and reduced risk. If you're younger and have decades ahead, you might go 80% stocks, 20% bonds. If you're closer to retirement, shift gradually toward more bonds for safety. This 3-fund portfolio is simple, effective, and used by thousands of successful investors. Why index funds can make you rich. The secret weapon of index funds is compound interest. Let's say you invest $500 every month into an index fund that averages 8% returns. Over 30 years, you wouldn't just have $180,000 of deposits, you'd have over $745,000. That's the power of compounding. Your money earns interest, then that interest earns more interest, and so on. The longer you stay invested, the faster your money grows. If you want to build wealth the smart, simple way, index funds are your best starting point. So, download my free beginner investment checklist linked below to help you set up your first portfolio. Check out the AI Income Builder Challenge if you want to add another income stream alongside your investments. And hit subscribe to Money Gainers Hub for more beginner-friendly guides on money, investing, and financial freedom. Remember, the best time to start was yesterday. The second best time is today. Start your journey now.